Joining us this morning, former S&P head of sovereign credit ratings, David Beers, is now a senior fellow at the Center for Financial Stability. David, really appreciate your time this morning. Thanks for being with us.
Happy to be here, Carl, with you.
Is this giving you flashbacks?
Oh, I'm not losing much sleep, but yeah, it has certain parallels with 2011 and certain differences too.
There's a lot of talk about what's different now than in 2011. Late cycle versus early cycle, inflation hot versus cold, M2 growth falling rather than rising. I wonder how you compare the two eras, this one and that one.
Well, of course, the U.S.'s government debt burden is higher, and it's actually higher now than what S&P projected based on the independent Congressional Budget Office back in 2011, because we looked at a 10-year horizon. Even before 2021, the public debt burden was rising more rapidly than what we assumed. And the other thing to say is that, or to remind your listeners, is the fact that S&P downgraded the rating from AAA to AA plus after the debt ceiling was resolved, and that was because we pointed out raised two issues. One was the rising public debt burden, which I just alluded to before, and also because we felt that the political polarization in the country was going to lead to recurring problems, such as what we're seeing now, in having Congress and the administration come together on fiscal policy.
Here's the one argument I have against the rating then and then the warning now, which is as long as we have the reserve currency of the world, which we do, despite some people thinking that we're losing it, we're not, and that's the U.S. dollar, it's not a problem, right? We can finance that debt. The world wants our debt. We have the deepest and most liquid market of our debt. And even if the payments have to get delayed, the money still will flow into the U.S.
Well, look, payment, a default is a default. So there's you can't say, oh, if the U.S. were to default on its debt even for a day, because remember, there's no grace period on U.S. Treasury bonds. So a default of a day is a default. And that's never happened before. It didn't happen in 2011, and hopefully it won't happen in 2023. But there is a rating scale, and S&P's current rating and the rating that Fitch may go to is AA plus. And the reason why the rating was lowered, as I said, is not because it was not contingent on the debt ceiling going away, but about the political issues, which are still very important today, the divisions in the country about fiscal priorities, and also about the fact that the debt burden is rising. And as far as the reserve currency role of the dollar is concerned, to me, that's a lagging indicator. It's not a leading indicator of credit. And the U.S. Would be reckless if it took the view that whatever happens, including whether or not it services its debt on time or in full, it doesn't need to worry because of the reserve currency position today of the U.S. dollar.